All right, you guys aren't here today because it's the holiday, but welcome to the Hurley Investments Market View Commentary for, I believe today is Monday the 30th. This will be a rather quick one because you guys aren't being asked questions, but each week I look for something to teach as well as what we're currently doing. And I can't tell you how many hours I spend just reading. And I try to find something that's like pro reasons to be bullish and then con why there wouldn't be. And I just do searches. Usually I'm up by around 5:30 and I just start reading for the next hour and a half till half hour before the market opens. And it's my time to see what I missed when I was going to sleep. I started on to this Lance Roberts, and I think I've been with him for 3 weeks now. Ran into him at the same time one of you guys sent me some information, and I just thought it might be interesting to give you stuff. And it's funny because people think more charts and more graphs, more history, more lines. Somehow it's more important. It's really not. But he came out with this article, Reasons to be Bullish, Are There Any? And he goes through a market review, are there any reasons to be bullish, portfolio positioning, and sector market analysis. So I'm just going to go through some of this with you because I found it rather interesting. Now, his charts are ridiculous. And what he's using is even more ridiculous. But the market finally rallies, and he's using a 20-day DMA, which I believe is the daily moving average. Not a simple moving average, a DMA. And I'm just going to check to make sure. DMA, technical analysis. And it's a displaced moving average, excuse me. What is a displaced moving average? This is from Investopedia. A displaced moving average is a moving average, MA, that's been adjusted forward or back in time in an attempt to better forecast trends or better fit the price movement of an asset. So basically it's taking certain days to try to predict. So with all due respect, what a useless, stupid average to use. I kind of giggle because a lot of people talk about the 100-day simple moving average. No one uses the 100-day simple moving average except for those dummies that are on TV. Real people that are trading money, a Goldman Sachs, a Merrill Lynch, a hedge fund, nobody uses a 100-day simple moving average. In real life, nobody uses a 20-day displaced moving average. So here you have that, hey, if you've shifted around to fit your chart, it tells you it's a buy signal. Well, obviously, we just had 3 days that it went up. That was stupid. The circle part that he has there, there's no reason it bounces there. It's a displaced moving average. But I do take a little bit in regards to the Fibonacci. And this, I think, is going to be rather important because Fibonacci retracements happen all the time. And if we just take a look at the SPX Fibonacci replacement, the gray horizontal lines measure the Fibonacci retracement lines measured from their late March peak to their May bottom. So number one, you get to place these lines where you see them, which is obviously extremely easy to do, but there are certain numbers that are important. 0, right? 8.3. I think you find 23.8. He uses 38.2. I really think it's better at like 36.4, 50, 61.8, 100, 138.2. I mean, the short answer is they're using these Fibonacci numbers and the Fibonacci lines, and what they are plain and simple, they're just herd mentality movements. And so I don't know how he thought to take them from the March highs, but you can move them around on your chart. For him, he's saying, hey, there's some herd mentality happening. But of course, up at the top, we're a little bit overbought right now. I'm just going to kind of go through these charts because they're not all that important. Markets are weakest when narrow. Duh, if you've got a narrow group of stocks that are moving versus a broad group of stocks that are moving, of course it's weak. It means that FANG stocks are moving that are moving the whole market. Down 13.72. Some of you trade Lululemon down 14.5. Disney 24.37%. Square, kind of one that definitely is one that is definitely down and down big, right? 35.66. None of us trade Twitter. What was on the other side over here? Somebody questioned me about GameStop, down 54.24%. Zoom video chats, 58.32. Boy, if we could find Baidu, it would also be down quite a bit. I found some of those that I thought were pretty interesting. Starbucks, we were looking at them, right? Down 7.7%. Those of you that trade Tesla, down 17.31. Delta Airlines is down 26%. American Airlines, 30%. I bet United is not in here because it's down even more. So it's one they'd have to pay attention to. But significant amounts of stocks are down. And they're down big, which is easy to say. And all they're trying to tell you is that, plain and simple, in a market where just FANG or a small breadth of stocks are down, well, then obviously it's going to be a little more difficult, right? A little more difficult to justify, hey, it's just these five. It's common sense. I don't know what the guy is really trying to teach, but I did have to giggle a little bit. All right. More advanced decline daily chart. Hey, if there are more decliners than advancers, the market's going down. That's pretty easy to understand. I liked, are there any reasons to be bullish? I'm just going to go and run to his, are there any reasons to be bullish, right? We discussed the high bearish sentiment, oversold conditions, seemingly endless selling of equity with the Fed set to rate hikes over the next few months to 50 basis point increments, inflation running hot, the economy slowing, investors' negative bias is not surprising. Of course, from a contrarian point of view, such begs the questions, are there any reasons to be bullish? And in the short term, the answer is yes. So a risk on, risk off sentiment, they have is a 4.9, which is just the same as the buy sell that in the last couple days, right? You could basically say 4.9 stocks are purchased for every one that's sold. That's the easiest way to say it. I guess it's that simple for me. Insider buying's picking up. It's nothing major. You could actually look at a put call ratio, which would give you a better idea. But insider purchasing is a little bit above insider selling. It's, I don't know. Again, a useless chart in my understanding. Technically overbought, oversold. We're definitely oversold. I found it interesting that when they were talking about some of this, that it was again, common sense. I don't know how you put a number on it, but I just look at my chart. This week's macro event, the Federal Reserve will probably be less aggressive on monetary policy and improve as expected. Valuations will be priced for slower earnings growth. Common sense. I don't get it. Let me go to what I pointed up last time, though. Couple interesting thoughts. Too many longs are trapped, meaning that most people who are looking for an out for some of their losing positions. And I did find it somewhat interesting that they made the comment, so many longs are trapped. In fact, as they went through their portfolio update, here's what these guys do. They are 31% cash, equities at 44.8, ETFs at 23.4. They kind of went through sectors and broke out how they're doing in each sector, which I think it's a chart up here, which is, I'm going to go through that with you, which I found is pretty interesting. But here are their actions to take on this rally. Properly sized portfolio positions to mitigate the risk of concentrated positions. So what they're saying is, if we're over concentrated in a position, like treasury bonds, right? Or like cash, you should reposition. Rebalance portfolio allocations. Number 3, take profits from highly overbought and extended positions. Well, with all due respect, there's not much that's overbought right now, or extended profits, right? Sell your laggards. So they want to sell your high ones and sell your low ones to make a zero interest rate, not zero, a zero taxable event. I did like the idea, when you are not sure what to do nothing. Cash is an excellent hedge against risk. Don't dismiss the value of bonds in your portfolio. It's like my hell. I would definitely dismiss bonds in a portfolio. They have lost more in the market than the equity positions, and look for non-correlated assets to mitigate risk. I did find that was a little interesting, that, hey, try to find gold, try to find silver, try to find maybe oils. But again, if you were to really put positions into there, once again, you would be in overextended positions. Just something that I thought about. Take a look at this chart. I don't know where they got all this from, but take a look at this chart from RIA Simple Visor. I don't know if I agree with all of these, but I do think it was kind of funny that year to date, that was down 12.57. The maximum drawdown was 20.72, which is correct. The Sharps ratio and Sorrentino, I don't understand. The volatility doesn't make sense. But I just went through looking at some of the positions, and really what I thought was interesting were their sectors. Because sometimes you guys ask me, well, what are those 11 sectors, right? Energy, materials, industrials, discretionary staples, healthcare, financials, technology, telecommunications, utility, and real estate. Those are the sectors that are broken down. So when you hear me say, hey, we want to find 7 to 8 stocks that touch all 11 sectors, that's what we're looking for right there. But I found it interesting that the 1-year price return, energy's up 70.35%. Materials is 0.15 down, industrials 9.39, discretionary 12.42, staples is up over a year, healthcare is up over a year, financials is now 4.7, technology is up over a year, telecommunications is down over the year, 22.98, utilities is up over a year, and real estate's up over a year. I found it interesting that if you were to put those for the current year, you would be surprised at what those numbers are. Again, when you see a year price return, not year to date, something's being hidden. Something's being hidden. It doesn't make sense. And those numbers don't add up for what we're seeing year to date. So I'm just showing you guys a lot of charts, a lot of information. A lot of this stuff is truly completely useless. Overbought, oversold again, the fear gauge. As I went through this, I giggled because all I'm seeing is a lot of BS thrown in front of you to make it look pretty. It's not going to help you. It's not even accurate for understanding some of the things that are important to anything. So it makes me wonder. With that said, let's move on to a little more understanding. I use briefing. It's not as beautiful and colorful as what you just saw, but it's simple. It's simple, it's short, it helps you understand. What I'm really going to go to is usually just the bottom here, what it all means. Shift work is not typically easy, yet the stock market made it look somewhat easy this week. Everything rebounded for the most part. And it was the market's most beaten down areas, like mega cap stocks, semiconductors, semi-discretionary issues were among the best performers. In the end, it was largely a sentiment-driven rally that presumably got the added benefit of month-end rebalancing activity. The stock market had a lot of work left to do, however, to make it clear in hindsight that this week was more than just a temporary shift work. So I enjoyed it. I enjoyed as you went through. It's simple numbers to explain what's happening. Idea that inflation might have peaked, right? China's economy is getting going again. The higher inflation themselves, particularly food, gas, and create demand destruction. Declines in real earnings and personal savings, currently its lowest since 2008. Prompt consumers to take down less expensive items or cut back on discretionary spending. Inventory bloat, which is interesting because I don't know. I think because of COVID and supply chain issues, who the hell has an inventory bloat, right? Let's face it, we're facing higher inflation and things are just getting more expensive. All right. Where will the markets end this week? I'm going to say lower, even though we've had 5 amazing days. The reason why I'm saying lower is it looks like the Dow Jones Industrial Average could very easily hit the 50-day. And I think there are a lot of orders stacked up on the 50-day and that center pivot point. Not to mention I don't know. We're technically bullish right now. I just don't see us getting over the 50-day on no news on the Dow. If we're looking at the S&P, same thing. Technically bullish. We have our crossovers, right? Crossover bullish, 4,158 to where 4276 is the 50-day in line with the center pivot point. I think there are a lot of sell orders stacked up right there. I don't see us getting over the 50-day at 4276 or the center pivot point at 4283. So I think we could go up and hit it right back down and come back down to where we're at. I'm kind of hoping for a flat week, but we will see. And then if we go to the NASDAQ, I almost think this one could go higher because it has 800 points to the upside. Again, almost technically bullish. We are not bullish on the RSI. Technically, it's 0.73, but that can get averaged out in a day or two where it'll look like we just hit it and came back down. 50 days at 12,919. We're at 12,131. 800 points to the upside. It's the one that could move higher, that doesn't have a resistance level hitting up above it. I am going higher for the month. And I'm going to start off with June being up 3%. And all I'm doing is saying, hey, May we were down 8.5, maybe as much as 12, but we rebounded back. I'm just looking for a flat to up month where not a lot's going to be going on except hopefully some better news in Ukraine, and we'd go from there. Tomorrow, Hewlett Packard, Salesforce, and Sportsman's Warehouse report. Webull, GameStop, NTAP, PVH, Hormel on Thursday, nothing on Friday. It looks like I might not have put in our economic reports. So we have Housing Case Shiller, we have the Chicago PMI numbers coming out, and we have consumer confidence on Tuesday. Wednesday, we have the ISM manufacturing, along with the typical MBA numbers. We have the JOLTS numbers, and we have the construction spending. All right, what do we have on Thursday? Thursday, it's kind of unique. Initial continuing claims, the ADP employment numbers that usually come out on Wednesday will be Thursday because we have a shortened week. We have productivity that I can't spell worth beans. Thank you. Word. Unit labor costs. Costs. And we have factory orders. On Friday, a pretty typical average work weeks. We have the NARN farm payroll, private payroll. We have the hourly earnings, and these are the ones that always come out, the average work week, the unemployment rate, and the interesting one, we have the ISM services index. They usually call these, the non-manufacturing. How are we looking to trade? Currently, I started to let positions run without protection. That's what gave us the beats on Wednesday, Thursday, Friday, where we outbeat the market as a whole on all of those days. We are also, like we said, ready to start to add some shares back into the portfolios, as we have been holding on to cash since last November. So just something to keep in mind there. We are cash heavy in general on accounts. I found it pretty interesting, a couple unique things that came up. This goes all the way back to 2021. And the Fed is losing credibility over its inflation narrative, Mohamed Aran says. Again, this is Monday the 15th of 2021. Here we are in May of 2022. I just suggest you read through it because, boy, was he right on. And again, there's no true economic model, algorithm that can state or explain inflation. It just, again, it's really stupid. You're trying to find a repetitive, builds on itself daily type of I'm just not saying this right. You're trying to find simple returns in a volatile market. You're trying to find an average algorithm in an exponentially moving market. They just don't go together. You can't predict the future that way. It doesn't make any sense. Old document, I want you to read it. Found it interesting. Schwab, Team Ameritrade Fidelity accused of collusion and price fixing. I've wondered on a couple of our fills. Please read through. Obviously, it's denied by Schwab. This one is also a little bit old. This is March. But Treasury Secretary Janet Yellen says Americans will likely see another year of very uncomfortable high inflation. This was March of 2022. I want you to go back and remember some of the things that she said so we can look to what's happening in our future. I found it interesting as I went through JP Morgan Chase's report that they were being hit by Russian sanctions. At least that's what they said as I worked through their schedule and their 13. Yeah, it's very easy to see where they are losing some money. I found it interesting. Utah collected nearly $14 billion in tax revenue in 2021. A lot of people just want to say, well, that's because the deadline was increased, but it wasn't. In my state, they've collected more taxes last year for 2020, which was, boy, how do you say it? Which was COVID, which was people didn't have jobs, which to my explanation as I read through this, it's justifying the stimulus packages, which is just bull crap. It really is absolute bull crap. But they're giving that, hey, 2020, when they collected their tax revenue in 2021, the most taxes ever in our state. And it's because people had free cash flow. Well, taxes are on earnings, and people were out of work, and people had checks coming to them for stimulus. It just, again, none of it adds up. But here we are saying, hey, stimulus was good. We're paying for it now, but some people just don't get it. And again, startup investors are warning of dark days ahead as boom times are unambiguously over. Just some interesting information on understanding what we're up against and what people are going to be looking for in the near future when it comes to new startups or new, really, growth in the next year. With that said, guys, I hope you're having an excellent Memorial Day. I will have this posted so you guys will have access to it first thing Tuesday morning. I'll send out the link. We look forward to talking to you on Thursday. And from there, you guys, hopefully you'll have a good week. Talk to you later. Bye-bye.